There's a lot of trust in Wall Street analysts to go out and do very deep dives into companies to help get a better understanding of them so that investors can make better financial decisions with that information. However, they're not always that accurate. Have you ever considered the idea that two analysts with the same credentials can have a buy rating on one stock and that same stock has a sell rating from another analyst? This makes a lot of investors, sometimes including myself, not actually take the advice seriously at all unless it's to maybe further some sort of confirmation bias. But what if I told you that there was another source of information that had a way higher accuracy of actually outperforming the stock market that is very much real? Not to mention that it's much more publicly accessible, more credible, and much more punishing whenever the researchers get it wrong. What I'm talking about is insider trading, the legal kind. See, it's not always illegal whenever company insiders engage in trading their own company's stock if they actually report it to the SEC in a timely manner. But what can these trades tell us going forward, and where can we find them is all going to be answered in this video. But it's not like following insiders is such a lofty secret. It makes total sense. Insiders like key executives and directors have the most up-to-date information whenever it comes to the company's prospects, knowing all sorts of things like order flows and supplies to production bottlenecks and the actual costs of it. These are all key ingredients for business success that insiders are going to have way before analysts, and then, not even to mention retail investors, right? Now, it's hard to tell if the business is actually underperforming if the insiders are actually selling. Look at Tesla, for example. Elon Musk was actually selling due to, a reason of just acquiring a completely different business. While is Tesla themselves actually failing? Well, that's for another video. But the point is that they could be buying a house or buying a business or something along these lines. It's really hard to read in between the lines of insider company sale. But insiders buying shares only happens for three main reasons. The first is alignment of interests. When insiders own a share of the own stock that they're actually working for, they are actually helping themselves rather than just, the shareholders. People tend to work a lot harder if they know they're going to actually see a direct benefit rather than just working for someone else. The second would be confidence in the company in general. When insiders are willing to purchase shares of their own company, it's an amazing signal showing to shareholders that the company's insiders are also with you, knowing that the company is still positive and growing. And lastly is the very obvious financial reward. This is the number one main reason why insiders buying shares of their own company, because they think that it's going to go up at a later date. If then the company actually does well, then these insiders will have benefited from these additional purchases, which then could lead them to a better financial future. Now, this whole next part is going to be based around the professor at the University of Michigan Finance, Najat Sahun's book that's actually called Investment Intelligence from Insider Trading. This is absolutely a fantastic read and filled with a ton of information on insider trading. And the first great part, in fact, is the idea that insiders actually make more profits from their insider trading activity than they would if they were to just invest in their overall broader markets. This is why it's so important to follow what insiders are doing, because they are outperforming. Now, I should point out as well is that there's a huge difference between key executives and directors. Directors know much less about a company's outlook than the actual CEOs and CFOs of the company, which are the key executives. Obviously, the people who are running the company are going to know most about where it's headed, especially whenever you understand that these key executives are fed very important information from all of their department heads that tell them all sorts of things about their business. All sorts of information like economic trends, industry trends, global trends, demographic, technological, political, consumer, and even market trends. All of these things are very important going forward for a CEO and CFO to make their best decisions. Now, you can see that the table that is taken from Najat's book not only shows you that investors are actually making more money than the markets after they've purchased shares, but they make more money based on how many shares they're actually purchased. So the higher amount of conviction in their purchasing, the higher reward we could possibly see 12 months from now. But those are just the insiders. Whenever we look exclusively just at the key executives, these numbers get even higher depending on how many shares they've purchased. This is why in SoFi's case, for example, a company that I cover very extensively on this channel, their CEO, Anthony Noto, has been buying shares like crazy. This is a massive vote of confidence for their shareholders, and not only that, the size of trades are getting into the millions of dollars. Just in the last month, Anthony Noto purchased an additional 1.6 million shares worth of SoFi Technologies. But Professor Najat Sahun's research goes even further than this. He even concluded in this research that a surge of insider purchasing market-wide could actually show a very good indicator for finding a bottom on the market, and vice versa for selling, which is kind of what we saw whenever Elon Musk and Jeff Bezos and all these people were selling at the top of the last year's market. Now, I can't say that we're seeing a full market switch in the amount of CEOs that are actually purchasing shares, at least at the breakneck speeds that Anthony Noto's buying them at, but I will say that there's definitely more insiders purchasing now than there was back in 2020 and 2021. Now, if you're wanting to keep track of all the insider trading activity the same way I do, I use Market Beat with their insider tracker. It's completely free. You can go ahead and see all of the different CEOs and what they're buying and what they're selling. CEOs have the deepest understanding of their company operations and strategic decisions, and they may be in a great position to make really well-informed decisions about their company's future value. However, they may also be biased due to their own personal involvement in their company's future. Analysts, on the other hand, will use more objective-based thinking whenever it comes to looking at a company's future financial value. However, they may have a lower level of company insight whenever it comes to their overall operations. Relying on only public information to make a bet higher than, the potential accuracy of a CEO might not be as good of a decision as one could think. Evidence also suggests that insiders, whenever they do make their purchases, will make them nowhere near any sort of catalyst for the company to, sort of stop any sort of run-in with the SEC. So although CEOs like Noto have been purchasing shares like crazy, don't expect any sort of critical news to come out rather than just simply a strong company performance. Personally, I think that the company's performance has been stellar, and I did a roundup in this video right here, so go check that out if you're interested. But aside from that, if you could, like this video and subscribe down below if you want to see more financial content just like this. Bye for now.